Thanks, Angie. It's my pleasure to be here tonight, and I just want to give you a little bit of background on CFC. CFC is a national financial cooperative that was created to provide funding for rural electric cooperatives across this country. Today, CFC is an organization that has $22 billion in assets. While our primary focus is providing capital, CFC also provides a lot of other services to our cooperative members. We do a lot in the area of training and education programs for directors, executives, and staff. CFC also provides management tools for budgeting, financial forecasting, and performance analysis. One tool to assess performance is our annual key ratio trend analysis. The KRTAs, as we refer to them, are a way for management to review their financial and operational data with the other 837 distribution cooperatives across this country. It's also a way to compare with the 43 distribution cooperatives here in Minnesota. While cooperatives vary in size from anywhere from 1,000 up to as high as 200,000 members, we try to also compare cooperatives based on size. Size has a bearing. And so when we look at Wright-Hennepin, we like to compare your system to other systems in that 50,000 range as far as the number of customers. As a lender, CFC has a keen interest in the financial and operational performance of your cooperative. Each year, I meet with your board of directors and management to discuss the key ratio trend analysis and highlight areas of performance and talk about the trends in the industry. Tonight, I'd like to share with you a few of those as we go forward. And the first one I want to talk about is, if I get this to move here, is the total utility plant. If you look at the trend in utility, and this is from 2000 to 2012, looking at Wright-Hennepin's growth, you can see that it's gone from almost $75 million to almost $145 million. Now, while that seems like a lot, that's pretty typical in the utility industry. Our average system grows about 5% historically. It has slowed down the last few years with the economy slowing down, but this is a very capital-intense industry, and with that, it needs a lot of dollars. And the way to get those is either through the rate structure or borrow them, and typically it's a combination of that that allows the systems to continue to grow and improve your system as you replace plant. Another ratio we look at is the revenue per kilowatt hour sold. This chart, if you look at the green bars, that's Wright-Hennepin's numbers. That's your cooperative's values for 2008 through 2012. If you look at the blue line at the top, that is the trend in the U.S. as rates continue to move up. If you look at the red line, that is Minnesota. Now, what's significant about this is while Minnesota has been moving up, Wright-Hennepin has not been moving near as quick. In fact, if you look from 2008 to 2012, Minnesota rates increased almost 26%, while Wright-Hennepin's went up just slightly over 11%. So you had very good job of keeping the rates down. When you look at operating expense and ask why did that happen, you can see once again in this chart, and this is one I think your cooperative is probably most proud of. When you look at the blue line, once again, it's the U.S., and it kind of gets blended in with the red line up above as it matches very closely with Minnesota cooperatives as well. You can see the trend all across the country is rising costs as far as operations. Once again, the green bar is your system, Wright-Hennepin's values. And if you look at the line in there between, it's kind of a gray line that we've added. I guess it shows up kind of dark blue up here. That line is systems your size. And I put that in there specifically so you can see it's not just size. You're significantly below systems your size. When we look at operating expense, the expense of your cooperative is 37% below the median system in the U.S. and is 22% lower than systems of your size. There are certain benefits to go with size, but overall, I think you can see your cooperative has done a tremendous job in managing the expenses of your cooperative. One of the things we look a little bit further into that, I like to look at what are those costs, where did they come from, and if you look at one of the things I reported to your board is we always talk about the highs and lows. Where is the cooperative high areas and where are the low areas. And I'm pleased to report you didn't have anything showed up in the high category. We flag anything that shows them the top 10% of the country or the bottom 10%. In your case, we flagged consumer accounting expense and administrative and general. Administrative and general is those wages and salaries of staff, their legal fees, they're the maintenance of your building. It's also, when you look at A&G, it's also your director's fees and expenses. And when you look at those compared to the country, you can see they're all green here because they're all in the bottom 10% in the country. If you look at total controllable expense and you dig deeper in that, your actual controllable expenses are in bottom 5% in the country. When you consider there's 837 cooperatives, you're in that bottom 40. That's kind of a nice place to be. You can see that overall controllable expenses and total operating expenses, they all showed up in that lower 10% in the country. In summarizing, I'll share with you what I shared with your board of directors, some of the areas that stood out. One is Wright-Hennepin is unique from the standpoint you have a lot of residential accounts and a lot of small commercial accounts. You're 60% residential, 30% small commercial. In the utility industry, the general blend is 30% residential, or a third residential, a third commercial, a third industrial. You don't have those large loads to serve, which makes it for a more challenge for management and the board of directors. If you look at your average investment per consumer, it's about $1,400 less than the average systems your size. That's significant. When we look at the expenses I showed you earlier, you've done a great job there. And then when you look at your financial performance, CFC is very much aware of your financial performance. As a lender, we pay close attention to your times interest earned ratio, your modified debt service, and your equity levels. And all those are very strong. You're in a strong generally fund position, and you have low losses as far as line loss, and your outage times are very low. So what that means for you as a member is your rates are low. You have some of the lowest rates in the state, and I'm pleased to say you're in very sound financial shape, and it's always a pleasure when I come out to work with your board of directors and management. I know that they're a very progressive board. They're always forward-thinking. They're always looking to see what they can do better to serve you. So it's a pleasure to work with them, and I'm glad to share this report with you. Thank you.